If you've been making charitable donations, but you haven't been able to deduct them on your taxes, that's about to change. The One Big Beautiful Bill Act, say that 3 times fast, just passed, and the changes starting in 2026 could transform the way that you gift to charity. So, most people lost their ability to deduct charitable gifts when the law raised the standard deduction back in 2017. So, although this simplified taxes for millions of Americans, it did also mean that the vast majority of charitable donations stopped getting any tax benefit. So, there's 4 changes in the new tax law that could either save you thousands or cost you money if you don't adapt your giving strategy properly. I'm Bjorn Amundsen, a certified financial planner here at Quarry Hill Advisors. I help people navigate the complex tax strategies that can help you maximize your charitable impact and minimize your taxes. Over the past few months, I've been diving deep into the new legislation to understand exactly how this affects your charitable giving. So, by understanding these 4 key changes and adjusting your charitable giving approach accordingly, you can potentially save more on taxes while making a bigger impact with your donations. And the families who adopt to these changes early are going to have a bigger advantage over those who don't. So, in this video, we're going to walk through exactly how the One Big Beautiful Bill changes charitable giving rules and what specific actions you can be taking before 2026. The first change is a big one, and it's one that actually indirectly affects charitable giving. The state and local tax deduction cap has increased from 10,000 to 40,000 for taxpayers who have incomes under $500,000. This higher state and local tax deduction might push more people over the standard deduction threshold, which makes them itemizers again. So, if you become an itemizer because of the higher deductions, your charitable gifts become fully deductible again. Of course, they're still subject to the income caps that we discussed. And if the state and local tax deduction now puts you over the standard deduction threshold, you might not need to do some of the strategies we were doing with our clients earlier, like bunching charitable gifting as aggressively. The second big change is there's now a universal charity deduction for non-itemizers. Starting in 2026, taxpayers who take the standard deduction and don't really get to normally deduct their charity, they now get to deduct $1,000 for single filers or $2,000 for married filing jointly, as long as it's a cash gift, not appreciated stock, and it's made directly to a qualified operating charity. So you couldn't give it to a donor advised fund. Since the Trump tax law in 2017 raised the standard deduction, about 90% of households had to stop itemizing their deductions. This meant that about 90% of charitable donors completely lost their tax benefit from giving to charity. This new universal charitable deduction brings back those tax benefits for smaller donors. So, if you're charitably inclined and take the standard deduction right now, you should consider contributing the full allowable amount each year, $1,000 if you're single or $2,000 if you're married filing jointly. This is essentially free money from the government for doing something you're already doing. Now, again, note that this excludes things like donor advised funds. So if you've been using a donor advised fund, you're going to need to make direct gifts to the charity for this particular deduction. So the third big change is that starting in 2026, itemized charitable deductions are only going to apply if your total donations exceed 1/2 of your adjusted gross income. So if your AGI is $200,000, only the gift that's above $1,000 would be deductible. So this could mean that smaller donations might no longer reduce your taxes or reduce them as much as you would hope if you don't clear this new threshold. So it could even eliminate the tax benefits for regular or smaller donors who like to itemize. So how can we solve this? One of the good ways to do this is by bunching your charitable deductions. We would like to combine several years worth of donations into one tax year so that we can clear that deduction floor. So instead of giving away $5,000 per year every year, where you won't get to deduct the first $1,000 or $2,000 or maybe even $3,000, what you might want to do is to give away $25,000 in year 1 and then give away nothing in years 2 through 5. Now, you can still be donating on a consistent basis to the charities if you donate that $25,000 to a donor advised fund and keep your same $5,000 annual gift going out to the charities. So you get a bigger deduction, you avoid the floor, but the charities never feel the difference. The fourth change is a change in the deduction cap for high earners. So they're hitting us a little bit on the floor, but then they're also capping the benefit a little bit. So starting in 2026, taxpayers who are in the top federal income tax bracket are also going to see their charitable deduction benefit capped at 35%, which is down from the potential benefit of a full 37% today. So this means for high income households, people who have roughly $700,000 or more of taxable income for married filing jointly, the value of your deduction might fall slightly. So what this really means for you is 2025 might be your last shot at a full 37% tax break. So let's break it down with a real example. Imagine you're a married filing jointly couple with $1.2 million in AGI, lucky you, and you're going to have $1 million in taxable income because you want to donate about $200,000 in cash to your favorite charity. Now, we know they should do appreciated stock, but just to keep the example simple, we're going to say they're giving $200,000 of cash. In the old rules, well, you gave away $200,000, so you get a $200,000 deduction. You're in the 37% tax bracket, and therefore your tax savings are $74,000. So you give away $200,000, you save $74,000 in federal taxes. Now, in the new rules, once the big, beautiful bill kicks in 2026 and beyond, first, the 0.5% of an AGI floor won't count. So in their case, since they're making $1.2 million, the first $6,000 that they gift isn't going to count. Second, the 35% benefit cap is going to matter because their total itemized deductions are going to be reduced by about 5%. And so their effective charitable deduction drops down to $182,000. So now this means their tax savings are about $63,700. So that's $182,000 times 35%. Now, that may seem like it's still a big amount of taxes saved, but it's about $10,000 less. Now, do keep in mind that you can carry forward any unused charitable deductions to future years. But for the present, that means your benefit in 2026 is going to be about $10,000 less. So for people thinking about giving a big amount to charity in 2025 or 2026, it's really worth evaluating if 2025 is going to be the year for you to do that. So let's pull this all together. The One Big Beautiful Bill creates both some opportunities and challenges for charitable giving. Small donors are going to get their deduction back through the universal deduction. High income donors have to act fast in 2025 to maximize their tax benefits. And everyone else needs to think strategically about timing and bunching to navigate the new deduction floor. So now that you understand how these new tax rules affect your giving, you can use this information to make more intentional decisions about your year-end giving. The most important deadline to remember is that things change after 2025. So December 31st could be the last year where you get the full 37% deduction if you're a high earner. If you want to learn more about how these strategies could apply to you and how we help our clients navigate these types of things, click on the link in the description to learn more about our systematic financial planning process. Thank you for your time and attention, and we'll see you in the next video.